It's a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies
Mhm.
because they understand the difference between money without any counterparty risk and currency with counterparty risk. So, what they're telling us is hold on, this whole system is looking a bit dangerous. The gold price has been rising basically by foreigners, and we're talking about central banks, if you like, national wealth funds, ultra high net worth individuals in Asia and all the rest of it, well, there's a lot of them now, they're buying gold. And they're buying gold for the reasons which we've been discussing. Silver is not part of that story.
The US dollar's share of global foreign exchange reserves has now dropped to its lowest point in 30 years, currently standing at 57.4%. Central banks are actively diversifying their reserves, shifting toward gold and a mix of currencies such as the euro, yen, pound, and even some non-traditional reserve currencies. While central banks spent decades shedding their gold reserves, a reversal began roughly 10 years ago, with a renewed focus on accumulating gold. Alasdair MacLeod, head of research for Gold Money, explains the dynamics of a typical bull market in precious metals. Speculators usually lead price movements, followed by institutional investors and eventually the broader public. However, central banks, particularly in China, have acted proactively in reducing US dollar holdings and increasing gold reserves, driven by geopolitical uncertainties and diminishing trust in Western currencies. According to the IMF, central banks' gold holdings have surged to 1.16 billion troy ounces, valued at approximately $3.80 trillion, while foreign exchange reserves total $12.30 trillion. This reflects a significant strategic shift, as central banks seek to hedge against systemic risks by prioritizing assets with no counterparty risk. Much of the recent gold accumulation aligns with geopolitical concerns and declining confidence in traditional reserve currencies. Despite gold's strong performance over the past 2 years, particularly compared to U.S. equities, sentiment in Western markets remains subdued. Portfolio exposure to gold is still less than 1%. Some institutional investors, however, are beginning to take note, adding gold as a strategic asset to diversify portfolios.
I would say that the futures and forwards markets are doing what they should do. Basically, it's speculators taking a view on where the price is going. I mean, they're looking at it, they are inevitably looking at it as gold is going up because you're accounting in dollars or whatever. Okay. The answer, as far as physical markets are concerned in the West, is that sentiment is very poor. Nobody's really bought into this. I mean, they really haven't. If you look at sort of total, sort of portfolio exposure, it's probably less than 1% is exposed to gold. Now, given that gold is real legal money, that's an extraordinary situation when there is so much risk around with all the debt and everything else. It's bizarre. A lot of it is due to the fact that the Americans have run a very successful propaganda campaign trying to remove gold from the financial system. And so for the last 50 years, people have come to believe that rather than the reality, the common law reality, plus the accounting reality, the difference between money and credit. So the sentiment just isn't there, and we're beginning to see a little bit of demand coming for ETFs now. I think that demand, I mean, we're seeing it more in America than we are in Europe, but I think that demand is from investment managers, big investment managers, are not necessarily buying into the concept of gold, but see that the price has been rising, etc., etc., and this is something which makes sense to include in a portfolio. So I think we're seeing that sort of advanced institutional demand. I mean, what tends to happen with a bull market, if we can just think in those terms rather than the true terms of the relationship between gold and credit, what tends to happen is that you find that the speculators will begin to drive up prices first. You will then find that more serious players will then get in on the bandwagon, and the last people to play the public, because they will have seen that something has risen and it's risen and it's risen and it continues to rise, and therefore you've got to buy it because it's obviously rising. It's obviously rising. This is the place to be, particularly if everything else is not looking good. So we haven't got that ETF thing, if you like, virtually at all, except for a few institutions who are beginning to adjust their portfolios. And I think that probably sums up the current situation. Gold has this additional factor that, ahead of the speculators, you've got central banks who begin to look at their reserves and the balance of reserves and all the rest of it, and they start adjusting things. Now, it is a common statement that the Central Bank of China, the People's Bank of China, has been buying gold. That's not the way to look at it. Actually, what they've been doing is dumping dollars. Now, that, if you understand the difference between the two, it tells you something extremely important. And this is in common with all the other central banks. And remember, they've been told by Vladimir Putin, who's had his reserves stolen by us, don't trust the West, don't trust their currencies, buy gold. He's pretty much said that. And, so you sort of think, these guys, I tell you, the central bankers I've met are actually pretty cute. Most of them do understand, sort of, if you like, the outcome for the purchasing power of foreign currencies, et cetera, et cetera. It's just they're not in a position really to do anything about it themselves. But, the fact that central banks continue to buy gold, in fact, they're pretty much cleaning out all the mine supply, tells you quite simply that these guys really are in the know. They're ahead of the speculators. The speculators can see it, so they go and buy. And, the poor old swaps and bullion banks find that they're getting squeezed. But I don't think we need to dwell on that too long. But no, I think it is a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies because they understand the difference between money without any counterparty risk and currency with counterparty risk. So what they're telling us is, hold on, this whole system is looking a bit dangerous.
Turning to silver, McLeod identifies its undervaluation. The gold to silver ratio currently stands at an unusually high 91, far exceeding historical norms. This disparity stems in part from silver's removal from the monetary system. Despite its vital industrial applications and scarcity, silver is only about 8 times more abundant than gold. Years of low prices have discouraged exploration and development, resulting in stagnant mine supply even as industrial demand surges. Silver inventories on the LBMA and COMEX have halved over the past 2 years, reaching their lowest levels since 2010. Without substantial supply growth, these dwindling inventories could trigger a market squeeze, forcing prices higher. McLeod predicts that a significant rise in gold prices may serve as a catalyst for silver to follow suit. The rising demand for gold reflects a shift in how investors and central banks view safe haven assets. Fiscal imbalances, geopolitical risks, and the declining appeal of traditional safe haven assets like treasuries are likely to bolster gold's strategic importance in 2025. Similarly, silver's ties to gold and its broad industrial applications suggest that it too could see a significant uptick. What do you think about the role of gold and silver as safeguards during times of monetary instability and systemic risk? Share your thoughts in the comments below. Don't forget to like, subscribe, and hit the notification bell to stay updated with our latest insights and analysis.